Gross profit margin, it is the ratio that shows how well the cost of production has been controlled in relation to distribution and administrative costs. So how much have we utilized the cost of production in relation to what? The administration and the distribution cost. So gross profit margin is given by gross profit over sales times 100. And you put percent so that whatever you get here will be a percentage. Then we have net profit margin. So net profit margin, it measures the firm's ability to control its production, operating and financing costs. How well can we control all our costs? Then this one will show you. We have net assets turnover. Turnover, it gives a guide to productive efficiency and how well assets have been used to generate the sales. So net assets turnover is equal to sales over capital employed. Capital employed in the line. Yeah, we have seen it. Okay? We have operating profit margin, operating or profit margin ratio. So this one, it indicates the efficiency with which the costs have been controlled in generating profits from sales. So operating profit ratio is profit before interest or tax, profit before interest and tax over sales times 100. Then we have operating expense ratio. It indicates the firm's ability to control production and operating costs to generate a given level of sales. So operating expenses ratio is given by operating expenses divided by sales times 100%. Return on investment. It measures the efficiency with which the company uses its total funds in capital employed to generate returns to the owner's funds. So return on investment is net profit after tax over capital employed multiplied by 100. Return on equity. It measures the efficiency with which a company, other suppliers' funds, or a company releases other suppliers' funds to generate shareholders. So this is return on equity is earning attributable to equity shareholders divided by equity multiplied by 100. When we talk about equity comprises of ordinary share capital, share premium, and what? And reserves. Activity ratio. Activity ratio, we have debtors turnover. Debtors turnover, it shows the number of times debtors pay within a year. So it indicates how efficient the firm is in management of credit. So the higher the ratio, the more efficient the management. So debtors turnover, we calculate it by credit sales over average debtors. Average debtors, you get them by debtors at the beginning of the period, add the debtors at the end of the period, divide by 2. That is debtors turnover. You have debtors day, debtors ratio. Debtors ratio, it's also called the average correction period. It shows the average period of credit taken by customers who buy on credit. So it is compared with the company's around credit period by suppliers to give an indication of the credit administration efficiency. So it will show whether we are efficient in collecting money from debtors, because the money that we collect from debtors, it is the one that we use to pay the creditors. Na lazima hii ikuwe nyingi iko ile. Ndio tukue tuko kwa biashara. Otherwise tutakuwa kama tunalipa nyingi kuliko zile tuna collect, inamaanisha tunafanya biashara gani? But in a company when you have volumes of sales, huwezi jua, lazima uanze kufanya hizi mahesabu kama hizi tunafanya. Sawa? Ndio inakufanya ukalia hapo chini. Usome, si ndio? Ukifika huko mbele ni wewe na kampuni sasa. Saidie kampuni za wenyewe, jisaidie. Na kiweka debtors ratio is equal to average debtors over credit sales is the number of days in a year. So for example, assume a 250 days year. So you need to assume so you get 365. So the debtors ratio, you can also get it by the number of days in a year divided by debtors turnover. This one. Sawa. Then let's go to creditors turnover. Creditors turnover, it indicates the number of times creditors are paid by a company during a year. So credit turnover is equal to credit purchases divided by average creditors. Then we also have what? Creditors ratio. Creditors ratio is also called the average deferral period. Average deferral period. This is average collection period. This is average. It indicates the average times that suppliers allow a company to settle its dues. It is given by average creditors divided by credit purchases multiplied by the number of days in a year. It is also the same as number of days in a year divided by creditors turnover. So this indicates the efficiency of a firm in selling its product so as to generate sales. So it shows the number of times the stock is turned over or it's converted into sales. The number of times we are converting our inventory into sales. So it shows how rapidly the stock is being turned into cash through sales. So the stock turnover is equal to cost of sales. You divide by what? Average stock. Then you have inventory conversion period. This one, it indicates the number of days it takes to convert inventory into sales. The fewer the number of days, the more efficient the company is in converting the stock into sales. So this one, you get into as average stock over cost of sales by number of days in a year. Then it is the same as the number of days in a year over Then inventory inventory turnover. Pamoja. So this was 6. Working capital cycle. This is also called the cash working cycle or the operating cycle. This one, it is the period for which working capital finance is needed, or working capital financing is needed. So the higher the working capital cycle, the higher the investment in working capital. What is the working capital? Then it is the period of time that elapses between the point at which cash is spent on production of or purchase of raw materials to the time the stock is converted into cash. The cash that it takes from when you are buying materials, it's cash imeenda, to the time when your material imeenda na pesa imerudi. That period. Huwezi jua kwa kampuni unless ukae chini ufanye mahesabu. Sindio? So working capital cycle, it looks like this. Average collection period. Tulikuwa tumehesabu hii sana. Then add inventory conversion period less average deferral period then what you get is the working capital cycle. So cash turnover or operating turnover. Cash turnover, it shows the number of times a company needs to replenish its working capital in a year. So cash turnover is equal to the number of days in a year divided by the working capital cycle. We have the fixed assets turnover. It indicates the level of sales generated by fixed asset base of the company. So it shows the efficiency with which the company utilizes its assets to generate sales. So this is sales over the total fixed assets. Like that. Then lastly, investments or equity ratios. Number 1, we have earnings per share. This one indicates the amount of shareholders, the amount that the shareholders expect to generate in form of earnings for every share invested. So it shows the profitability of a company on per share basis. So earning per share is earnings attributable to equity shareholders. Not any other shareholder, only equity shareholders, divided by the number of ordinary shares. So these are ordinary shares dividends only. Then we also calculate dividend per share. Dividend per share, it represents the amount of cash dividend that shareholders expect to receive for every share invested in the company. So dividend per share is equal to total ordinary dividends divided by number of ordinary shares. Then you have dividend payout ratio. Dividend payout ratio. This one indicates the proportion of earnings attributable to equity shareholders that are paid out to common shareholders as dividends. So it is used in analysis of dividend policy of the firm. So dividend payout ratio is calculated by the total common dividends divided by earnings attributable to equity shareholders multiplied by 100%. In short, it is dividend per share over earnings per share. So if you have calculated this, calculate this one, you just use that formula. Okay? And multiply by 100. You get the same thing. Then, dividend retention ratio. Dividend retention ratio is given by retained earnings over earnings attributable to equity shareholders multiplied by 100%. Fifth, we have dividend cover. Dividend cover is given by earnings per share over dividends per share. Look at this. So, then this one does not have it. Then you have earnings yield. Earnings yield, it measures the potential return that shareholders expect to earn for every share invested in a company. In short, it evaluates the shareholders' return in relation to the market value of a share. So earnings yield is equal to earning per share over market price per share multiplied by 100%. You have dividend yield. It measures how much an investor expects to receive from cash dividends for every share purchased or invested in a company. So dividend yield is equal to dividend per share over market price per share multiplied by 100%. Then we have price earning ratio. This indicates how much an investor is prepared to pay for company's share given its current earning per share. So the higher the price earning ratio, the more confident investors are that the company will perform well in the future. So price earning ratio is equal to market price per share over earnings per share. So that is how we analyze financial statements. Okay. Limitations of ratios. Number one, subjectivity. So ratios are subjective to accounting information that depends on accounting policies adopted by a particular organization, hence making it impossible for cross-sectional analysis. So look, that means we depend on information that has been prepared using accounting policies. So imagine we are comparing to when you're doing ratios, tunataka kujua these two institutions, they do the similar business, isn't it? We want to compare their profitability, isn't it? But you find that our walitumia different policies na hawa. Unajua ratios zenyewe zitawasaidia. It is subjective. So it depends on the accounting policies adopted by a particular organization. Policy yenye mlitumia kupata net profit, sisi tulitumia ingine, kwa hivyo profitability issues zetu hazitasaidia, hazitakuwa very nice for comparative, sindio? Irrelevance, that's another limitation. So ratios are historical figures which may be relevant in making future decisions, sindio? Yeah, some of them are irrelevant. It is qualitative aspect is ignored. So qualitative aspects such as competent management or experience and motivation of employees, they are not captured here. Tuwezi pata profitability ratio. Na labda profitability yetu haikuletwa na nini? Na those figures zimeletwa because the staff were motivated. Wakafanya vizuri, wakaconvert sales. Convert inventory to sales haraka. So we don't consider such things here. Tunafanya hesabu. So, ambiguity. So different people use different stresses to describe financial information. So then there may be the including of preference share capital in equity or return on capital being referred to as the gross capital employed. Those ambiguities. Some people, the way they interpret this is different. Wengine wanasema ni attributable to equity shareholders. Total common dividends, when I include dividend mpaka za preference shares, kwa dividends are. Okay? Ambiguity. Usefulness. Ratios are computed at specific point in time. So by the time they are analyzed for decision making, circumstances may have changed. So sisi tunaweza tengeneza financial statement, saa hii tutengeneza ratios, lakini based on hesabu za last year, si ndio? And then kwa hivyo what we are doing labda haitasaidia management to make decision. Tuko tunataka make in April. Usefulness and monopoly. For a company without competitor, it may not be possible to analyze its performance with other companies in the same industry. Yeah. So if a company does not have a competitor, then hatuweziweza kuanalyze their, we don't have the comparison figures. Sasa, let's go to past papers. So, after past papers are ATD between 2015 to 2023 up. So, the CPA, ATD, and also the ATDA, financial management, the same topic. Okay. FM.